Welcome to Wealth Explainers. Today we're breaking down the boring truth about millionaires and what's really happening behind the scenes. Picture this. It's a Tuesday morning. A guy is standing in his brightly lit kitchen making a turkey and cheese sandwich. He packs it into a plastic container, washes the knife in the sink, wipes down the counter, and grabs his keys. He walks out the front door and gets into a 10-year-old silver Toyota. The paint on the hood is starting to fade. He turns the key. The engine hums to life, and he drives to the local public library. He walks through the quiet aisles, finds a thick, hardcover book, and sits by a large window to read in the afternoon sun. Now, imagine a digital counter in the corner of the screen, tracking his net worth. With every bite of that homemade sandwich, every mile driven in that old car, and every page turned in the library, the counter is relentlessly ticking up. You keep watching the scene, waiting for the cinematic reveal. You expect a hard cut to a luxury yacht cutting through the ocean, or a high-stakes corporate boardroom, or bottle service at an exclusive club. But the scene never cuts. It stays completely, remarkably boring. And that is exactly the point. The complete absence of yachts, heavy car payments, and expensive restaurant bills is the exact engine driving that counter upward. The quiet, uneventful afternoon is what financial growth actually looks like. Here's the part most people miss. We are culturally conditioned to look at spending and mistakenly call it wealth. When you see a massive house, a brand new luxury SUV, or a closet full of designer clothes, your brain immediately assumes you are looking at financial success. But in reality, you are looking at the exact opposite. You are looking at capital that has permanently left that person's bank account and been transferred over to a car dealership, a mortgage lender, or a retail brand. Wealth isn't the money you spend, wealth is the money you keep. But because keeping money is invisible, our culture equates having money with the act of spending it. Now, this is where it gets interesting. Because of this mix-up, people look around at high earners who are living paycheck to paycheck, and they get completely confused. They think, if making $200,000 a year doesn't make you rich, the whole system must be broken. What they are missing is the difference between an income stream and a capture rate. Think of your income like a running faucet and your bank account like a bucket. It doesn't matter how far you open the tap if the hole in the bottom of the bucket is just as big. Your capture rate is the percentage of money you successfully trap before it drains away. A high income combined with high consumption just creates a lot of running water, but the bucket stays empty. The guy making his own sandwich and driving the old Toyota is actively capturing his income. By minimizing the structural drains on his cash, specifically his transportation and food costs, he has effectively plugged the holes in his bucket. On the surface, it looks simple, but there is a major trap here called the cash flow illusion. Society tells us that when you get a promotion or a raise, the logical next step is to upgrade your lifestyle. You earn more money, so you lease a nicer car. You earn more money, so you rent a more expensive apartment. Because your monthly cash flow gets bigger, you feel like you are moving up in the world. But your actual net worth hasn't moved an inch. Your new income was instantly absorbed by new, higher fixed expenses. The guy in the Toyota simply opted out of this illusion. By locking his living costs at a low baseline, he structurally guaranteed that whenever his income goes up, that new money flows directly into his net worth. And this is the key. Just capturing the money isn't the finish line. Because cash sitting idle loses its purchasing power to inflation, you have to convert that trapped cash into productive assets. This means buying ownership in businesses through index funds or buying real estate. When our guy is sitting in the library reading his book, he isn't actively working for a wage, but his previously captured capital is. His money is out in the global economy, generating dividends, earning interest, and growing in value. The counter keeps ticking up because his assets are doing the heavy lifting, completely independent of his physical labor. His wealth has begun to generate its own wealth. So why is this so difficult to do in the real world? It comes down to human psychology. We are wired to expect immediate, proportional rewards for our effort. If you work a brutal, stressful 50-hour week, you subconsciously feel like you deserve a tangible prize, a premium purchase, an expensive dinner, something you can see and touch to validate your hard work. But the architecture of building long-term wealth completely denies you that immediate hit of dopamine. The reward for disciplined saving is literally just a slightly higher number on a digital bank statement. It feels passive. It feels unremarkable. To someone used to the emotional highs of continuous consumption, stability can actually feel like stagnation. You watch your peers enjoy the immediate, visible status of spending, and you feel like you're falling behind. The brain struggles to value the invisible security of wealth over the visible status of spending. Let's zoom out and look at the broader financial principle at play here. This all comes down to the concept of asset escape velocity and the structural fragility of your lifestyle. If you play the status game and constantly expand your spending to match your income, you build a highly fragile life. You become entirely dependent on your next paycheck to keep the whole operation running. If you face an economic downturn or a sudden health issue, the foundation cracks instantly because you built an expensive life, but you didn't build a financial buffer. But if you play the boring long-term game, you reach a tipping point. When you first start out, your daily labor is the only thing pushing your net worth up. It's a grind. But as your asset base grows over 5 or 10 years, the math starts to shift. The return on your investments begins to contribute more to your wealth than your actual savings deposits. Eventually, you hit critical mass. The annual passive growth of your assets becomes larger than your annual living expenses. Your wealth has achieved escape velocity. It will continue to grow on its own, regardless of whether you ever clock in for a shift again. Your past decisions have literally purchased your present autonomy. What this means for you is a total shift in how you view success. You stop looking at gross income as the ultimate scoreboard, and you start looking at net worth. You stop judging financial stability by the cars in a driveway, and you start looking for the quiet signals of a high capture rate and a growing investment portfolio. You realize that a quiet, low-key life isn't necessarily a picture of financial struggle. It is very often the picture of absolute financial control. Building real wealth doesn't require a cinematic lifestyle, a sudden stroke of luck, or a genius-level intellect. It requires the simple discipline to widen the gap between what you earn and what you spend, and the quiet confidence to let that margin grow in the background. If you found this breakdown helpful and want to continue learning how the financial system really works, please hit that subscribe button, give this video a like, and leave a comment below with a financial topic you want us to cover next. Thanks for listening to Wealth Explainers, and we'll see you in the next episode.